What's up, everybody? Welcome back to the channel. Today I want to do a quick reactionary video with Randy Warren. This was televised on CNBC. He's just talking about what he thinks the market bottom might be. It's a little bit vague, but I think it's still worth looking into, and we can see what kind of stocks he's looking at. If you guys are new to the channel, my name is Jay. I love talking about personal finance, the stock market, trying to retire early, as well as being out of debt, and just financial independence in general. So in today's video, I'm going to react to Randy Warren. Then after that, we'll go ahead and look at a couple of the indexes, and then I'll kind of give you my plan of what I plan on doing for the next couple weeks, and then we'll look at like the Fear and Greed Index as well as the AAII, and then of course we'll look at Pongo again, my little beagle. If you're new to the channel, please consider subscribing. I'm trying to build a small community here. Go ahead and smash the like button, leave a comment down below what you think, and let's go ahead and get started.
Welcome, Randy. Can it be trusted?
Good afternoon. Well, I really love this rally, but at the same time, I don't really trust it. But you have to be a little flexible, because at the end of the day, every new bull market starts with a bear market rally. So you've got to be a little bit flexible here, but you also have to be very careful. We're bumping along the bottom.
I think that that's a pretty obvious statement. However, I think with how bad sentiment is and like the Fear and Greed Index, all that, no matter what, everyone's going to always just say, oh, it's just another bear market rally. It's another bear market rally. Eventually, it will actually be a bull market, a new bull market start. And anyway, just with how bad the sentiment is, I think that's a fair thing to say.
And it's just hard to imagine that the market's going to make a lot of extra progress when the Fed still has a lot of work to do in terms of raising rates even further than they have so far.
If you don't trust these rallies right now, what would make you change your mind and say, okay, this is the sustainable rally that we want, that the bottom is in?
Yeah, one of the keys here is holding this 3,600 level on the S&P. If we keep on making new lows, that's obviously going to be bad news for the rally. It's just not going to happen, and we're going to have to wait even longer. But if we can hold somewhere, and I'm not a precise person who says 3,600 is the number, but you need to basically hold this area that we're in the S&P 500 and say, this is the low. We're bumping along the bottom. And, as you were saying earlier, the earnings look pretty good. They're coming in already. And so there's a possibility that the stock market and the bond market may start to look past the recession that we're in, and may start to look past what the Fed is planning to do in November and December.
My personal thoughts on that, I mean, that's also pretty obvious stuff to say. To say we're not going to have a lower market, we can't keep going lower. That's pretty obvious. However, I think the good point here is the stock market is going to try to time the Fed the best it can, because the Fed is driving this market right now. Everything is based on inflation and the tightening of the economy by the Fed. So the stock market, when I say the stock market, I mean like big money, like the hedge funds, multimillionaire investors, all these people that are going to put tons of money back in the market when they think it's going to go well. They are going to be able to decide when the bottom is. They're going to be putting all this money back into the market, like, a couple weeks to a month, maybe 2 months, 3 months before they think the Fed is going to actually pivot. So they're going to try to be in the game beforehand. So they're basically going to create the low when all this money goes in at the same time. So anyway, I think a lot of this has to do with when the Fed is going to pivot. So,
Randy, if you don't trust the rally, then how do you use what you do trust to inform your strategy?
Yeah, it's really tough right now, because you can look at all the fundamentals of the companies, and so much has been wrecked this year. If you want to look at, revenue growth and earnings growth and all the different, metrics that we typically look at, instead you really have to pick carefully. You have to pick strong companies that are going to for sure be there when the new rally begins. Stocks like Lockheed that you were just talking about, and Salesforce, Lockheed being one of our top 10, and things like Tesla, NVIDIA, Airbnb. These are great companies, and they're for sure going to be there when the next rally begins. So if you're holding the high-quality stocks, even if they're, you want some value, you want some growth, but you need to hold those high-quality companies that have good management and that you can count on to be there when the rally really begins and the bear market is over and a real new bull market takes over.
So just to piggyback on that, if you don't think you're able to pick the best companies, you can look at balance sheets and all those things. You can pick companies you think you know that are doing well. But if you don't want to do all that homework, you could just put money into the S&P 500. It's literally going to be the 500 strongest or biggest companies in the U.S. You could put it in like the Dow Jones, which is like the top 30 companies. We did a video the other day about like the barbell strategy. So you could put like, some money in a Dow Jones, like a less volatile index fund. You could do some in the S&P 500. You could do some in the NASDAQ, and also you could do some in the Russell. The Russell and NASDAQ being a little more volatile, a little more risk reward, and then you have the Dow, which would be a little more stable, ideally, and pays a little bit more dividend. While I'm not a financial advisor, my personal strategy, I can tell you this, I'm not telling you guys to do this, but my personal strategy is I have about 85% of my money in index funds, and the other 15% is in single stocks. I do also hold all of those index funds I was talking about, basically a Dow, but mine's actually in a dividend ETF, which is a lot of Dow type companies, and I'll link a video here. We talked about the dividend ETFs before. I have a lot of money in SPLG, which is a S&P 500. I have some money in the QQQM, which is a NASDAQ play, and then I also have some money in a Russell 2000, which is like the small caps. So you could do a mix of like an index fund and individual stocks if you want. Another option, if you really think you're really good at picking stocks, you could just go all stocks. That's up to you. That I personally think that's a little too risky. It doesn't even matter how much money you have in the account. If it's like that's how much money you have, let's say you have $10,000, and you don't want to risk all of your money. Let's say you have $500,000, you don't want to risk all your money. So if you're going to pick individual stocks, I would at least be diversified over different sectors. Like you could be in tech, you could be in like banks, and you can be kind of diversified through different like consumer staples. You can be diversified through a bunch of different sectors. Sorry, I went on a little rant. We'll get back to the video here.
So you say great companies that are still great, but stocks are beaten down, like Costco, Home Depot, Chipotle, among others. Why, are there others?
Oh yeah, there's an endless list of stocks that are beaten down. I mean, you can go with
True.
Apple for sure. I mean, we were buying Apple, as much as a month or two ago, and we're still buying more Apple. Adding to positions. Now if one of our clients already has a bunch of Apple, we're not adding to it. But if anybody was a little bit light on Apple, it's like, hey, let's add a little bit more Apple. It's cheap right now. Yeah. That's where people need to really think in terms of being a shopper. Stocks are on sale. They're 20, 25%, 35% off, depending on what stock you're looking at. And if you went to the store and the stuff you wanted to buy was 30% off, you'd be pretty happy.
Yeah.
So I know that only makes people happy who are buyers now and not holders for but when you get a good entry point like this, you really want to ride this into the next 3 years.
Randy, you have given us a perfect segue to our next segment where we're going to talk a little bit more about Apple. Thanks.
So I just want to talk real quick about him saying the stocks are like, 25% off, 30% off, 50% off, whatever he was saying. I don't think that's necessarily true. I think that stocks last November were overvalued. So if you think that the stock you buy today is going to get back to its all-time high of last November, I think that's going to be a problem for you. You need to be buying your stocks, if you're doing individual stocks, based on fundamentals and earnings, income statements, and like the forward projections of companies. I wouldn't just say, oh, it's down 40% from where it was, it's 40% off, buy it. Like, I think, I don't know if that's exactly what he was trying to say, but people could interpret it like that. So anyway, do your homework, make sure, look at your PE ratios, your price to sales, look at all those things, your income statements, look at all that stuff before just listening to like a YouTuber that's buying stuff. If you guys are still with me, please consider subscribing to the channel, smash the like button, leave a comment down below. Let's go and look real quick at all the markets real fast here. So right now I have the Dow Jones Industrial Average up here. Just think of the 30 like blue chip companies in the US. Anyway, the last 5 trading days were up 4%, a little over 4%. That's a pretty good move up. I'm gonna go ahead and look at the S&P now. So we got the S&P 500, that's the 500 largest companies in the US, and that is up 3.35%. So the Dow Jones is actually up a little more than the S&P, which I think is kind of interesting. So I got the NASDAQ pulled up here now. Think of the NASDAQ as like a big information technology sector or like a lot of tech in here. So you can see over the last 5 days, it's up 3.05%. So the Dow Jones Industrial Average is actually up higher over the last 5 days over the NASDAQ also. And typically the NASDAQ will move more either high or low compared to the Dow Jones in general. So that's pretty interesting. Also, let's go and look at the Russell now. And now you can see we got the Russell 2000 pulled up here. That is the 2000 basically smallest cap. So think of like smaller companies, but there's 2,000 of them. So this is also typically a little more volatile, like a little more risk, a little more reward also for this type of investment or index that it follows. Anyway, they're up 4.45%. So that's up the highest of all the indexes over the week. And you can see the VIX. I'm just going to do today because the VIX, there's no need to look over it the last week. Although it did hit over 34 over the last 5 trading days, it hit over 34 a couple times. Anytime the VIX is over 30, you could think it's kind of buying opportunity. Once it's under 30, typically the stock market's going up. That being said, if you're dollar cost averaging into index funds or individual stocks, just keep buying. Don't care about the VIX, it doesn't matter. Keep your strategy going. Real quick here, you can see we're still in the fear segment of the fear and greed index, and this is there's like 7 different things built in here in total for the fear and greed index. But we're in fear, so it still is kind of buying opportunity here based on that. And you can see the AAII sentiment is here, and bearish is 55.9%, which is still very high. You can see historical averages is 30.5. So it's still a very bearish market here. And if you look over here, it says you should be greedy because it's negative. So everything's looking bad. Therefore, you should try to buy stocks. So my strategy moving forward this week and the next couple weeks is going to be kind of the same thing I always say. I'm going to be dollar cost averaging in. Every Monday I put money into my account. I'm going to be buying some index funds, most likely S&P 500, as well as a couple individual stocks. I personally am going to probably be looking at Meta. Their PE ratio is still like 11, and I just really think that company is going to do well. They have a good balance sheet as well. All right, I hope you've enjoyed today's video. Like I said, please consider subscribing, join the community, smash the like button, go ahead and leave a comment down below what you guys' investment plan is going to be. And here's Pongo running in the park because we all love Pongo. So go ahead and leave a comment down for Pongo as well. All right, thanks guys.